Well, good afternoon, everybody. I want to thank you for fitting us in on your Monday afternoon, and we look forward to providing you with another insightful briefing on our monthly conference call series. In a moment, I'm going to invite Norm Dietrich, one of our investment partners, to come up and begin talking about the bond market, talk about what's happening in the world of commodities, as well as some of the international markets. Our other partner, Frank Massey, is out sick today, so FX, if you're watching, I hope you feel better. So I'm going to pick up part of FX's role after Norm and speak about the Fed, the U.S. economy, and the stock market. I first want to brief you on some upcoming events we have with our team. The first, I'm so excited to tell you, we are moving on Friday. We have been in this temporary Regis location since February, and while it's been helpful to have all of us close together, we have piles upon our piles in this very small office. And so we're excited to move to 656 East Sweetsford Road. We are about a mile west of the King of Prussia Mall and right where all the major arteries, 202 and 76 and 476, intersect near the Pennsylvania Turnpike near the mall. So a very central location, and we look forward to hosting everybody to a open house. January 9th is a Thursday, and so we want to take a couple months to get the place all decorated and spruced up, but we are going to be live there as of Monday. So you'll be getting an email with our new address, and you've been getting email updates with the new address, but that's effective on Monday, the 28th. We're bringing back an event that many of you asked for over the last couple of years. We were unable to host a shredding event over the last couple of years at our prior firm, but we are hosting a shredding event in our current office parking lot on Wednesday morning at 10 a.m. So please feel welcome to bring in old statements, old documents. We're going to have an Iron Mountain shredding truck on our campus here, and we'll be happy to help you from 10 to noon on Wednesday, shredding any documents that you would like. On Thursday, November 7th, we are having a very interesting dinner briefing. Over the years, many of you have asked about the security of your affairs on the internet, online banking, with social media. So we took that to heart and have been working for the past several months to secure a presentation by Dr. Paul Violas. Dr. Violas is frequently on CNBC, written up in the Wall Street Journal, credentialed one of the country's leading authorities on helping affluent families protect themselves online, on the internet, doing financial transactions, and even things like when you host a party in your home, when you travel on vacation. What are some basic, simple checklists that you want to go through to make sure that your affairs are safe? So please join us Thursday, November 7th at Waynesboro Country Club. We'll be serving a dinner about 6:15. And then for those of you unable to attend in person, we'll be hosting this through a WebEx as well. So what a couple of weeks we've had. A lot of volatility from some very challenging hours in the second week of October with the stock market, not knowing we're going to raise the debt ceiling or not raise the debt ceiling. But we've been through a number of emotions over the last couple of weeks, but we do have some visibility and some clarity. We want to share with you our thoughts on what we expect the next couple of months to look like as we head through the fourth quarter into 2014. So I'm going to ask my investment partner, Norm Dietrich, to take my seat and talk about our views on the bond market and on the international markets, and I'll be back in a few minutes. Norm?
Thank you, Greg. Good afternoon, everyone. On the interest rate side, we have a high degree of uncertainty with where rates are going to be in the future. Right now, we see firms such as Merrill Lynch estimating that by the end of the fourth quarter 2014, the 10-year could be at 4% or around there. On the flip side, we have other firms such as JP Morgan that's semi in the middle of that, and then Morgan Stanley that is more flat for the next 2 years, and then maybe 50 or so basis points higher. But the core theme, at least for US rates, is that we will have higher rates. So what drives that? What makes rates go higher? We've talked immensely about quantitative easing, what the Fed is doing, buying their own securities, and how that has artificially driven rates to all-time lows. We've spoken about the great rotation that we've tried to move people out of bonds, especially the longer term, more sensitive bonds, into shorter term portfolios, which have traditionally been less volatile. So the great rotation moving from bonds to equities continues. We see flows getting stronger and stronger to the equity markets. We see some buyers coming in now that we're through with the Fed, with the bickering in Congress over the debt ceiling. So as we're moving forward, we're very optimistic that even if rates do go marginally higher, that they're not going to continue to spike. Bob Dole, who is now no longer with BlackRock, he's moved over to Nuveen, has always been somebody who is a more, I would say, common sense type of thinker. And right now, he is saying that in the short term here, we're on a counter trend rally. So rates he expects to go up in the future, but right now we've seen the 10-year Treasury come back down to around a 260 from close to a 3% level. So we do expect rates to revert, to go back. What do we have that's going to stop them from going higher? What's going to keep us from spiraling out of control? And I'll come back to points that I've made in the past. The consumer price index plus unit labor costs is a core calculation for inflation. We don't have worries in either of those two categories right now. The labor market, which we watch closely, seems to be stabilized. It seems to be not getting too much better, but slowly getting better, continuing the uptrend, continuing to push towards that 7% number that's kind of key. Ideally, we want 6.5, but it's so far from that right now that it is not something we're saying that rates are going to jump immediately in the future. The consumer price index also, while Merrill Lynch says 4% maybe by the end of 2014, they also have an estimate for core CPI, which they continue to push out through that same period of time at a very marginal 1.7 year-over-year increase. That's not enough to push rates dramatically higher. So when we talk about a great rotation, we talk about people moving money outside of fixed income into the equity market. We talk about the Fed stopping their quantitative easing, which is going to throw lots of US dollars back into the marketplace, and somebody's going to have to buy that. Fortunately, the other side of that equation is not there yet. Plus, when we go into the international markets, there's a strong demand for the US dollar. It is the global currency. Everybody knows that. Why is it critical? Because just as the US has done quantitative easing, the international markets, especially the emerging markets, Brazil, India, Indonesia, China, they're all fighting inflation much more so than we have here. Plus, everybody wants to devalue their currency. You hear about Abenomics, which is the Japanese equivalent of what we're doing. They're adding to the spending for public infrastructure. They're adding to quantitative easing. All that is going to have the effect of devaluing their currency. So as we end our quantitative easing, we still have these other markets entering and continuing to do quantitative easing. So what's that going to do? That's also going to assist in making the dollar stronger. That strengthening of the dollar will reduce the impact of any inflationary trends. So we're very comfortable that, while rates, we do expect them to go up and to normalize somewhat, that it won't be a severe or quick experience in the future. Traditionally, treasuries are always the low end of the curve. If we look back over the years, we can see that in the last 10 years, treasuries have been on the bottom of the fixed income market as far as performance in 5 of those 10 years. That's where we'd expect them to be. That's, again, one of the areas we tend to stay away from in this market. We would prefer to go into corporates and other items that have a larger possibility to earn return that aren't going to be directly impacted by the reduction in quantitative easing. So that's my fixed income commentary. On the international front, just a little bit about Japan, about the emerging markets. All these economies, China was a driver for commodities. They were pushing the limits out there, buying copper, buying iron ore, buying everything, and building their massive cities. They're slowing down dramatically. As a result of that, the demand for those commodities is slowing down dramatically. We've been at the end, just like we've come to the end of a 30-year kind of super cycle with interest rates, we're also near the end of a super cycle with commodities, or potentially near an end of super cycle with commodities, at least until these emerging markets start to heat up a little bit more. And while we don't have inflationary trends, the emerging markets do have inflationary trends. So they're very different than us. Where that might come to see an impact is in large cap companies in the US. They traditionally will have, in the last 10 years or so, much more exposure to the international emerging markets than the small cap in the US. So that's something we'll be reviewing a lot more closely, our allocations to large cap versus mid cap. And in fact, we've been doing that recently. We've moved a lot of money into the small and mid cap securities, one of our current themes for the year. And this is some of the rationale that goes into that decision-making process. In the future, in 2014, we will have Indian elections, Japanese economy with Abenomics impacting. We'll have Indonesia elections in late spring, French elections in May, and Brazil elections in fall. All of those tend to make the market a little jittery, especially in the emerging markets. In Europe and in the UK, we see a different picture. In those developed economies, we see more opportunity. They're starting to stabilize. The UK is experiencing non-inflationary growth, very similar to the US. Europe, while they've been in that double dip recession, is now starting to pull out again and show positive signs. So we are looking to expand in those areas as well. And we think that, the recession that they've had was very mild. The numbers that are coming out are positive, but they're very low on the positive scale. But we do think that they're through their crisis and should be following the U.S. markets to some extent, and also an opportunity there that we're following closely. With that, I'll hand it back to Greg. Thank you for your time.
Thank you, Norm. So lots of drama in Washington over the last couple of weeks. So what's our view? What's our take on what we've seen in Washington, D.C.? And I want to talk a few minutes about the Fed. I want to talk about the economy in general, what the outlook is for housing, consumer confidence, and then ultimately our views on the stock market. So last week's issues were front and center and dominated all the news channels and papers. It's estimated, S&P estimates that the 16 days of government shutdown will shave about a 0.5 percentage point off of fourth quarter GDP. And that total cost was $24 billion in the cost of having the government shut down for those 16 days. The interesting thing, though, is from the perspective of the Fed, in our view, very little attention was paid to the appointment of Chairwoman Janet Yellen. Ben Bernanke's tenure as the Fed Reserve Chairman ends at the end of January. And when Larry Summers backed out last month, the markets had a rally, and Yellen was formally appointed last week. And I think in the midst of all the goings-on with the debt ceiling, people didn't really talk about that appointment. But we think that's pretty important, because had Larry Summers taken over as Fed Chairman, there would have been a real concern about stopping the quantitative easing process right away. He made it very clear in his TARP discussions during the financial crisis that he was not a fan of stimulative monetary policy. Ben Bernanke, however, has been clearly, And Janet Yellen is absolutely in that same camp, making sure that the Fed is pushing the right buttons, will continue to purchase treasuries and mortgage-backed securities until the economic recovery is more sustained. So we expect very little change at the December meeting of the Fed. I think is the 11th and 12th, and we expect you're going to hear more of holding off of tapering. Most economists that we've read over the last few days suggest that given the shutdown, that puts the concerns of tapering well into the spring of 2014. So tomorrow we actually get the September employment report that was supposed to come out the first Friday in October. Is coming out tomorrow. And we are seeing modest ticks down in the unemployment rate. Jobless claims in September fell from 344,000 down to 305,000 for the last week of September. The unemployment rate itself went from 7.6 in August to 7.3%. But there's been a lot of discussion that was caused not by more jobs, but by a decrease in labor force participation. The labor force participation rate is the ratio of the labor force divided by the total population. It shows how many active workers are actually out there working and or looking for jobs. Since its peak in 2000 at 67%, the labor force participation rate has declined to 63%, reflecting a greater amount of discouraged workers, retirees, and students. This level was last that low in 1978, and the decline in the unemployment rate may be obscured by the fact that labor supply has been discouraged and people are simply dropping out of the workforce. Housing, too, started off the first 5 or 6 months of the year quite strong and weakened towards the end of the summer. Mortgage rates have ticked down recently, but spiked in June. If you all recall that second week of June when Bernanke talked about the taper and when they were going to stop the printing presses, and interest rates, bond yields really spiked on the 10-year Treasury. The National Association of Home Builders Index declined in October, and Gallup polls show a decline in the pace of the economy strengthening in the housing market. Sales of new homes fell in July before rebounding in August, and the Census Bureau reported the decrease of 14% in July and an 8% increase of new homes in August. New home sales provide a real-time glimpse of the impact of rates and mortgage increases or mortgage rate increases because they are recorded when the contract is signed. Unlike existing home sales, that sale isn't reported until it is closed. Existing home sales showed little impact from the increased spike in the summer, and data from the National Association of Realtors showed existing home sales accelerated in July and August, maintaining double-digit year-over-year growth. So our view is housing is accelerating. We are getting strength in housing. You're seeing buyers, this wealth effect, their assets are worth more. People are making moves to purchase homes, and we expect that that's going to continue. What I just said about Yellen, the Fed, and QE, we expect that mortgage rates, which ticked up in the summer, have come down, will remain attractive for some time. I want to speak about consumer confidence because we have seen those numbers change as well, even recently with this government shutdown. A recent CNBC poll showed that consumers were more cautious about spending towards the upcoming holiday season than last year. We think that's going to change. Our team's view is we believe that's going to change as we get closer to the holidays for 3 reasons. This drop in confidence, number one, was tied in part due to the government shutdown. People have short memories. As that shutdown becomes further and further in the past, or is further and further in the past, we think that consumer confidence will become more upbeat. The QE is likely to continue. The Fed is going to keep the printing presses on, at least for the time being. That should be supportive of the stock market, which I'm going to mention in a moment. And again, that wealth effect, when people see their 401k statements worth more, they generally are inclined to feel more comfortable spending money. Gasoline prices have dropped. Oil is about $100 a barrel right now. And national average unleaded is about 3.35 a gallon. So that's like a significant tax cut. That puts real money back into consumers' pockets that would go elsewhere. So we do expect that we're going to see some momentum in consumer confidence as we wind up the year here. So just talking about the stock market, last week we got most of our third quarter data in, and for the third quarter, the Standard & Poor's 500 was up 5%, an impressive quarter by any measure. But the EAFE index, which is the developed international markets, was up 11. U.S. small caps were up 8%, and emerging markets were up 5.8%. So as Norm mentioned earlier, as we've been talking with you in our meetings, we began shifting and increasing exposure to mid-cap and small-cap and international stocks really in the early summer as we began to see this dominance of U.S. large-cap stocks begin to wane. Our view is still very optimistic on the S&P 500, but we're positive on these other sectors as well. With political stability in Europe and a gradual slowing of growth in Asia, we believe that the developed emerging markets will continue to outperform the U.S. Small cap, we've seen more IPOs, initial public offerings, in the first 6 months of 2013 than we saw in all of 2012. That, coupled with this low interest rate environment, has really spurred M&A, merger and acquisition activity. You're seeing a number of acquisitions by larger companies of smaller companies. That all bodes well for small cap stocks, which typically do well in the beginning stages of an economic recovery. So we're a couple weeks into third quarter earnings season, and through the end of last Friday, about 50% of U.S. companies that reported beat on their earnings, and about 47% beat on sales. So we have seen a slowing in the pace of quarter-over-quarter growth, but still healthy beats on the earnings side. From a valuation perspective, by no means is the stock market cheap, but the trailing PE on the stock market right now is about 14 times its price to earnings multiple. So we don't think the market is rich, but nor are we suggesting the stock market is cheap. Our views are positive on stocks. I think that our team's view has been we're going to see the S&P 500 around 1750 at the end of the year, and I think we're going to hit, if not slightly exceed, that target. And our view is that we're going to see 1800 in the year of 2014, if not slightly sooner. So we are optimistic. We are in a slow growth economy. The data that's coming out is good, but not great. And I think you're going to see that theme reiterated over the next few weeks. You're going to see some choppy numbers given the government shutdown, but you're going to see the data showing slow and gradual acceleration. We're optimistic that the Fed is going to keep its foot on the gas and continue to maintain this policy of monetary stimulus, quantitative easing. And until we see, Bernanke's made it clear, and I'm sure Yellen will do the same, until we see unemployment under 6.5% and inflation exceed 2%, neither of which we're even close to, I don't think we're going to see any meaningful change in Fed policy. Corporate balance sheets are strong. S&P 500 companies are sitting on record levels of cash and are much more financially prepared for weathering storms than they were 5 years ago. U.S. banks are in a healthier position than they were 5 years ago. I think there's also something to be said for the large percentage of the population that has not bought into this market rally. I was reading a report on Bloomberg a few weeks ago that a poll of investment accounts at all major U.S. brokerage firms with account balances of $1 million or more, 20% of those holdings are still in cash. So there's a large percentage of our population that is still not buying into this rally. So with that, we're going to ask for your continued patience. We're going to look forward to meeting with you and calling you and going through some year-end tax planning ideas. We recently put together a 2013 year-end tax planning piece that we're going to be sending each of you and going over in detail. We are grateful for your confidence, for the trust you placed in our team. We hope to see you on Shred Day, Wednesday, 10 o'clock in our parking lot. We look forward to seeing you for our risk and fraud prevention dinner presentation on November 7th. Thank you for the confidence you continue to show our team, and look forward to having our next WebEx with much better equipment next month in our new office. Thank you.